lots of banks are expecting, or at least were expecting, the low 5,000s for the S&P 500. That puts us at around 20% growth. I think that is the absolute best case scenario we'll see this year. And some of those banks have already started the negative revisions that I think we will see sustained and continuously over the next couple of months. Now, why is that? So the geopolitical conflict have intensified many of the factors that had already concerned us in January. We're going to have energy price inflation. We see oil creeping up again, because I do not believe that there is a quick diplomatic resolution to this conflict. I believe that there's only one outcome that Putin is focused on, and I don't believe that will change. So that will cause disruption to one of the world's largest energy suppliers, which will continue that commodity price spike, which will in turn spur other commodity price spikes, wheat, metals, etc. More than that, the global trade flows have been disrupted. The supply chains are impacted. And I hate to put any skepticism on that dose of optimism you just gave, Brian, but BA2 is in fact causing some closures in Asia, which is further disrupting the supply chain. Now, before this geopolitical
Agreed.
conflict,
Looking at Asia, yeah, I'm trying to be optimistic on that, at least for now. As I said, Greg, I mean, it may not last, but at least right now, this moment in time, some kids, you can see them smile. I'm trying to find a reason to be happy with everything going off. You know, this is not hyperbole, Greg. This is the greatest energy and commodity price shock since at least the early to mid 70s. Period. End of story globally. All four previous price shocks have ended in recession. Do you think we're going to go into recession, which of course means that corporate earnings are going to come down, multiples are going to come down, and stocks are more likely to come down unless we have a buyer of last resort? Wink, wink.
I think it is far more likely that we end up in recession than we have an upside surprise in the fundamentals and the macro environment from here. And as you rightly pointed out, and you don't have to listen to you or I, the Department of Energy put out a report last Wednesday forecasting that oil would average 112 a barrel over the second quarter. And historically, when you've had that kind of price jump, if that is indeed going to come to be true, that plus a tightening Fed plus decreasing liquidity as they pull money out of the system is the perfect recipe for inflation. Now, let's dimension what that means. Typically, in the last 5 recessions, S&P earnings dropped about 30% on average. And so 30% from what most people are forecasting from here leads us to about $160 on the S&P. Yep. That's what we saw in 2019. And putting a 20 times multiple on that implies 3,200 for the S&P, a far cry from where we are today. And we could support that theoretically or philosophically by saying, yes, I do expect corporate earnings growth deceleration from the strong and intense headwinds on the top line and the bottom line that we're seeing across the board.